Let's talk macro for a bit. Rob Subbaraman of Nomura has joined in to talk about a whole host of issues. Rob, morning. Thanks very much for joining in. Let's start with the event which happened 24 hours back, China raising rates. What does it mean, or how did you read that, and what could it mean for commodities?
Well, I think for it to have impacts on global consumption and commodity prices, the interest rate hikes would really have to slow down Chinese demand significantly. And our view is that's not going to happen. I think important thing to understand is that even though China's raised rates 4 times now by 100 basis points, if you look where inflation is, very close to 5%, and probably soon is going to go above 5%, real interest rates, so adjusted for inflation, is still very low. The cost of capital, real cost of capital, is still very low. We would say monetary conditions are still relatively loose, and so we don't see much of an impact on China's GDP growth. We have our forecast for China's GDP growth for this year is 9.8%.
Good morning. Because of the events we've seen for the first part of this year, for example, what's happening in the MENA region and happened in Japan, would you say there is a risk to global growth targets as well?
I think it is a significant risk. We would emphasize that for global growth, the risks are skewed to the downside now. I think the starting point is that the global economy is still very fragile. The advanced economies are still emerging from the worst recession since World War II. And we have many shocks and vulnerabilities that the world faces now, ranging from the crises in Japan, which could affect the whole global supply chain of manufacturing in some industries, such as motor vehicles, to the situation in the Middle East and North Africa, where there is the risk that it drives commodity prices even higher, to very severe sovereign debt problems in the periphery of Europe. But also, don't forget, in some of the advanced economies, including the world's biggest economy, the US, there's an enormous amount of fiscal tightening that lies ahead to get public debt back on a sustainable footing.
ECB raised rates yesterday, Rob. Do you think it's a one-off, or could it be picked up as a trend in the Western world as the year progresses? And what ramifications could that have on liquidity?
I think overall monetary conditions globally are probably going to remain pretty loose. I think even if the ECB and the Bank of England start raising rates, they're not going to raise rates dramatically. And so I think we are going to remain in a situation where interest rates in Asia and other emerging markets as well, but particularly Asia, are going to remain well above those in the advanced economies. And that's probably going to continue to attract strong capital inflows to Asia, adding to the liquidity. I think the other thing is, our view at Nomura is that in Asia, many central banks still remain behind the curve. We think inflation is going to remain a pressing problem for the region into next year, and that real interest rates are still very low. Real interest rates in Asia are negative in 8 of the 11 countries that we cover, including India.
Just to bring the discussion to India though, Rob, what have you read of the inflation situation? How sticky do you think it will be, and what are you more worried about, the supply side of it or the demand side of it as well?
I think there's also demand pressures. Consumption seems to be holding up pretty well. Credit growth is also picking up in India. We do feel that India, in the very early stage of economic takeoff, where incomes are rising very fast, there is, I think, a growing demand for higher protein food. So I don't think you can just put it down to supply side factors. I think even in the food space, I think demand is playing a role. Of course, you need also greater investment in agriculture to help the supply meet that demand. But even outside food, I think there is evidence that non-food manufacturing prices have been rising. And in labour markets, there is evidence that they are tightening and wage pressures are building. So I think overall there is genuine inflation pressure in India. Our view is it's going to remain quite sticky, and I think there's a growing risk that into this quarter, as we go through this quarter, and perhaps even starting into Q3, inflation could actually rise further from the current levels.
So how do you think the Reserve Bank moves from here on with interest rates?
Yeah, I mean, we think the RBI is going to remain hawkish because of inflation. I think it is concerned about, with such high inflation, it's concerned about second round effects through inflation expectations. And so we do think that there is going to be more rate hikes. We don't think the RBI is done at this stage.
Just to bring or go back to that point on inflation though, Rob, how soon or by when do you think we would start to see a peak out or a plateauing?
Yeah, I mean, the work we've done trying to model inflation in India, the WPI, it's starting to look like it's more likely to be Q3 rather than Q2 when inflation peaks in India. And it's partly the base effects will take a while, but also lagged inflation has an important effect on headline, and also the demand side pressures. So it's looking more like Q3 is the peak.
The market took quite a bit of comfort post the budget on that low fiscal deficit projection, Rob. Will it be easy to hold on to that, given that crude is now at $123?
We do. We think it's going to be very hard for the government to achieve the smaller fiscal deficit target, particularly with the very aggressive assumptions on food as well as fuel subsidies. And we do think that most likely oil prices are going to average over $100 this year, and the fuel subsidies will have to be a lot bigger. It's a trade-off there. Without more fuel subsidies, there is the risk of more social unrest, of higher inflation, but providing the fuel subsidies then also leads to a wider budget deficit. And of the two, we think the government is going to have to give way somewhere, some part here, and allow more larger subsidies, and hence a larger deficit than budgeted.
Thanks, Rob, for joining in this morning with your thoughts. That's a view on the global economy and on us, and that's where Brent